And Dame Julia, thank you so much for making time for us today.
Thank you for having me.
You've got a tough job.
Following football, yes.
I mean, about London listings. We've got a string of takeovers recently. We've seen a lot of big companies choosing elsewhere to list. And on this stage, we've seen a lot of excitement. So I'm wondering how we can revive the animal spirits in public markets in London, especially when we've already heard some quite big talk from private equity on this stage as well. So should we start by talking about what you see as the biggest challenge to getting companies to choose London for listing?
Well, I think, let me tell you what I thought the biggest challenge was 4 years ago when I took the job and what I think it is today. The challenge we had 4 years ago is that we actually had a regulatory setup and a set of listing rules and an ecosystem that was not best placed to support the companies that were now the drivers of value in the modern economy. We had a set of listing rules that worked very well for what I might describe as companies with fixed assets that threw off a certain amount of cash, past performance predictor of future performance. Less good for IP-based companies and fast-growing companies. Fast forward to today, we've reformed our listing rules, we've reformed our research rules, we've increased the conversation about pension investing and retail investing in the UK, we've transformed our corporate governance and stewardship landscape, and we've created the world's first regulated crossover market between the private and public markets. So all of that means that actually, kind of toe-to-toe with any market in the world, we have a compelling proposition. I think the narrative, and I'm going to say this once, but I'm not going to say it again, the reporting about the narrative is actually out of date with the reality. So we see this with the clients who are being advised at the moment, put any listing jurisdiction side by side with London, particularly if you're a company sort of 20 billion and below in size, London wins. Hands down. Well, and that's what we're now promoting.
So Bloomberg's just reported this week that London has slipped out of the world's top 20 IPO markets, and this is based on deal volume. So down 69% this year to $248 million. It's the weakest in 35 plus years. I'm wondering, when you're looking at rivals internationally, are you looking at the US as the top rival because of the deeper pools of capital, the higher valuations, or are you more concentrated on Europe? Are you looking at Stockholm, Amsterdam, Paris?
So I'm looking at a different set of numbers than those. I think that's the first point. So we talk about IPOs, and I get it. Our biggest competition is with the US, by any measure. We're 2.5 times larger than the next European exchange in total capital raised this year. Okay? There have been 19 companies that have come to London this year that have increased the market cap by 45 billion. Okay? Now, that's not in that reporting. I understand why not, because it looked at IPO numbers. But one of our biggest was the movement of a Greek company, Metlan, from the Athens Exchange, where they reincorporated in the UK, relisted their securities in London, and then came straight into the FTSE 100. Okay? They didn't need new cash. So they didn't have an IPO, and therefore they didn't count in those stats. And therefore, what we focus on is the total amount of capital raised. And I'll give you a couple of other stats, which are, again, not widely understood. AIM had its largest ever capital raising this year. Rosebank raised over £1 billion to buy a US company from under the nose of private equity. Okay? So there is actually a lot of strength. Now, tonight, there is a US company that's doing the first ever dual listing in NASDAQ and London simultaneously. They are closing the market in NASDAQ and flying over here to open the market tomorrow morning, and that's a $13.8 billion company. And we've got another British company IPOing on Friday. So the simple reality is that actually there's a lot of activity happening. We look at our total size of capital raised year on year versus other jurisdictions, and the only place where we really have to compete now is the US.
So we report facts, put the journalism aside. This narrative, this negative narrative, why isn't it being turned around? Why isn't the vibe more positive? Is it because of companies themselves, CEOs? Is it politicians that aren't making the story more positive?
Look, I think the onus is on us and on me, which is why you see me out pretty much every evening having this kind of conversation, to make sure people understand the facts. And narratives are hard to pop. We have a uniquely British habit of talking ourselves down, and a uniquely British habit of talking about secular trends as particular to the UK. So, I mean, you may have seen that Jamie Dimon decried the decline in the total number of listed companies in the US, and his last shareholder, not this one, but the one before. That trend has happened in terms of take private in the US as much as it has in the UK. And yet we talk about it as a uniquely British thing. I think there is one thing we have to acknowledge, though, which is that the UK had a position as the largest financial centre as a consequence of being in the single market. Mm-hmm. We were the default choice as a consequence of being in the single market. Our listing rules and our rule set hadn't really changed because it hasn't really needed to. What has happened over the course of the last 5 years is actually a sharpening of focus on how to make sure we have the most compelling proposition that we can. But narrative lags reality. And our job is to make sure that it's reported accurately and that positivity comes through.
So when you're selling London to an individual company, I'm thinking about Revolut, homegrown London success story, and I know you don't want to talk about individual companies, but what are your tactics to try and get a Revolut to choose London over New York?
The fact.
Do you wine and dine them with the facts?
Well, I think I said on Bloomberg TV, I think I may have been the first person who ever quoted Lin-Manuel Miranda on The Breakfast Show, but I said we have to be young, scrappy and hungry in terms of how we fight for every listing where we feel we have a compelling proposition. And for the UK fintechs, we feel we absolutely do. And I'll give you a reason. It's not only that our rule set and the analyst understanding and the fact that you can get into the FTSE immediately, you wouldn't get automatic tracking in the US, is all very compelling. The other thing is actually the US markets demand companies inexorably move their centre of gravity to the US, which is why as a nation we should care that we keep companies listed here. But I mean, so that's one piece of it. The other piece, I'll give you some simple data. There've actually been only 20 UK companies who've gone to the US to raise over 100 million since 2014. Of those, 10 have delisted, only 3 are trading up and 7 are trading down by on average 74%. So the grass is not always greener. And I think it's also important that people realise what the proposition is, what the costs associated with listing in the US are, what the litigation risk associated with listing in the US is, versus what companies can get here, where they get indexation, they get the support, they get the home nation status, all of those things. So I think we just need to make sure we get that across. It isn't always in the economic interests of some advisors to give that message because the fees are higher to list in the US. I get that.
So are your tactics the same when you're trying to persuade a company not to delist from London? Because we just lost Petershill, for example, last week.
Yep. Look, I think companies will make, and this is the thing I feel it as a CEO of a company. I felt it when I was running a bank. You have to respect the strategic agency of any company. My job is to make sure a company has the best possible information to make the best possible decision. And one of the things we do have to make sure is that companies feel that they're getting the right support on the market. Now, there are times, and I think I may be pivoting to one of the things you want to talk about, but there is the delisting issue. And it is an issue both in the US and in Europe and elsewhere around the world. And look, I did something that I think was quite different to what a lot of CEOs of exchanges did when I arrived, which is say, rather than public markets from Mars, private markets from Venus, ne'er the twain shall meet, and we sort of have to go like that about the idea that private markets are evil, I have a very different attitude to it, which is that actually the most important thing stock exchanges do is as a convener. Our job is to bring together those who have capital with those who need capital in service of an objective. And most importantly, that's to facilitate founders being able to drive value creation in their companies. And if you think that's what venues do, we're a great big network effect. So I used to say we're Facebook before Facebook was Facebook. Then our job actually could be applied across the suite of companies' life cycle, not just when they're public. It's just that's all we'd ever done before. So we want to make sure that we can engage and support companies get access to liquidity at every stage of their life. But it's also a recognition as public markets, and it's not just for the UK, everywhere around the world, that our greatest competition now is actually probably not each other. It's actually the proposition in the private markets. And therefore, the public markets have to look at themselves and make sure they are as compelling a proposition. The UK has done that in a way that most other jurisdictions have not, I think.
So this is Pisces, the private intermittent Securities and Capital Exchange System.
Regulation, where the R is silent. Yes.
Much catchier, Pisces.
Pisces.
What I want to know is what kind of companies you want to take part and when we're going to see the first transaction under Pisces.
Okay, so let me explain what Pisces is. It's the world's first regulated crossover market between the private and public markets. What it enables a company to do as a private company is have an auction of their secondary shares at a periodicity of their choosing. And the design is aimed to enable those Mansion House Compact and Accord companies who've signed up to commit more of our UK pension fund money to private companies to be able to use their existing pipes and plumbing to be able to buy the company. It's to enable angel and seed investors to get out with a transparent price formation process. It's to enable companies to scroll through the VCs and the PEs. So if you need somebody to write a ticket that your current cap table can't write in size, then you can actually generate that liquidity event. And crucially, it's to provide liquidity for staff, to facilitate the ability to retain talent. Now, the UK is doing unique things, which is looking at the shape of its capital markets and saying, how do we maximise the efficacy of the economy that we want today and tomorrow, rather than this is how we've always done it. So the honest answer to your question of what size of company is, it varies enormously from companies who are, I don't know, say 200 million market cap to tens of billions in terms of who's looking at it. In terms of when I anticipate the first transaction, I mean, literally, we only got our license to operate this market last month.
Okay.
So let's bear that in mind. I would say I run a 300-year-old fintech, because I do. But also, this job is a 5-year forward. In other words, it takes 5 years to build a market and then 5 years to cement a market. But the simple reality is, I think we'll see companies in the first half of 2026. Because the preparation is, I mean, this goes to company agency. It actually is a serious amount to actually kind of change your articles of association, get all your legal documents in the row to make sure you can access this market. But we are seeing a steady sign up of what are called the registered auction agents, the banks that will facilitate those flows for the companies. We will be making some very big announcements in the coming days about the investors who'll be able to access that market. Nope. I'm giving you a trail. I'm not giving you the headline because I can't do that yet. But the simple reality is we're seeing massive momentum build. And the thing I'm fascinated by is we went into this with how do we solve these challenges for private companies, CEOs and founders? But now that we've built it, the founders are coming back to us with use cases, as are the Ps and the VC firms as well, and saying, we want to use it this way. Can it do it that way? Rather than thinking it's just a big block that I want to sort of sell to a pension fund, is it actually I just want to do an internal staff process and I don't actually ever want it to leave that ecosystem? Or I actually want a much more distributed cap table than I've got with a load of ultra-high net worth. The range of different use cases that's coming back to us is bigger, which tells me that it's filling a need that wasn't there before, wasn't met before.
So I've just come back from Labour Party conference. I've been talking to the Chancellor. I wonder what you want from her in the budget.
Yes. So the biggest challenge for the UK is that we have been, over the last 25 years, an equal opportunities under-investor in ourselves as a nation. You know, it's simply put, our pension funds invest less in UK companies.
Should they be mandated to invest in UK companies?
I'll come back to that. Our pension funds invest less in UK companies than any of their peer funds around the world, however you measure it. And our level of retail participation is lower than it ever used to be, and lower than a lot of our peer nations, even in Europe, let alone the US, despite the fact that the FCA states that there are 7 million cryptocurrency accounts in this country. You know, so the simple reality is that we need to address that. But we have a system of tax credits that we've written as a nation, 48 billion odd for pensions and 9 or 10 billion for ISAs, where we ask for none of that to be invested in the UK in return. We also charge stamp duty. So the same, I mean, we charge people to buy Aston
We don't have to. Stockholm doesn't. Should we get rid of that?
Well, the challenge for the Chancellor, and I fully appreciate this, is that is revenue that is 3 to 4 billion a year that is easy to collect. I totally understand it. So the question is, how do we get rid of the pernicious effects of it? We should not be taxing Brits to buy British companies and encouraging them to export our capital overseas.
And buy Tesla. Yeah.
So we tax people to buy Aston Martin who actually employ people in this country and build cars in this country. We don't tax them to buy Tesla or Porsche who don't.
But there's a solution to this.
There is, within the constraints of the public purse. And so it's going to be more complex to do. On pensions and ISAs, it's much less difficult. We write tax credits where we don't ask for anything in return. So you asked about mandation. For me, it's much more about saying if you want to be designated as a default pension scheme in the UK, then you should have a globally diversified portfolio, but not necessarily index weighted, which is not diversified because that basically means 70% of your money is in the US with a declining dollar right now. And actually, say 20-25% should be invested in UK assets of whatever description you have. Now, you can then opt out as a pensioner, get your full tax credit in the non-default scheme. But if you want to be in the default scheme, and the interesting thing is we've run scenarios on this, we've actually done a survey on this, or New Financial did. The average pensioner that was surveyed thought that 41% of their pension funds' equities were invested in the UK. It's about 4. Okay? 72% wanted the government to support their pension money going to invest in the companies that were the future that their kids would be employed by, simply put. And
so again, it's the story.
It's perceived as a political risk, but perversely, we have made choices in the last 25 years to actually create incentives to subsidise the cost of capital of the S&P 500, not the cost of capital of the FTSE 350. And most countries in the world look at us sideways. So I genuinely think that the thing that I'd love to see is the confidence to make that choice, to say, yes, we want Britain to be investing in itself again. And I'll say one thing, I have heard the argument, but there's nothing to buy here. Now, you just mentioned Revolut, okay? I see a remarkable number of entrepreneurs up and down this country doing remarkable, groundbreaking things every single day, you know? And I think if you look at it, the major pension funds in Canada, in Australia, the major endowments in the US, the sovereign wealth funds, where do they set up their first office to buy assets overseas? London.
Well, look, you've talked about remarkable fintechs, including your own, and overseas interest. We had the Euronext boss on Bloomberg TV saying that he might be interested in buying the LSE. It's easy to say it on Bloomberg TV. Have you actually had a knock on your door with an offer?
It's not for sale. No, look, I'll be very clear with you. It matters to me that I run the only primary exchange in the London Stock Exchange Group. That means I'm not in the slightest bit conflicted to be the biggest possible advocate for the health of the UK equity capital markets. And I operate in a group that has a market cap bigger than Euronext does. And I've seen what's happened to other exchanges in the group, because it's quite difficult to prioritise one when you own several.
Okay. Final question, 30 seconds. Are we going to see an IPO this month in London?
We're going to see one tomorrow and one on Friday. So there you go.
All right, great note to end on. Dame Julia Hoggett, thank you so much.